Over in the U.S., the inflation hit its lowest point in more than 2 years. Despite the drop, the Fed officials have signaled another rate hike by a quarter point at its next meeting this month. Our Eum Ji-young explains what this means for the rate gap between South Korea and the United States down the road.
The continued surge in U.S. consumer prices seen over the last 2 years finally seems to be cooling off. The latest consumer price index data from the Labor Department on Wednesday shows that U.S. annual inflation slowed to 3% last month from a year ago. It's been easing for 12 consecutive months, and it's a sharp fall from a 40-year high of more than 9% in June 2022. Some say then that the U.S. Central Bank's fastest monetary policy tightening campaign since 1980s is nearing an end. But with this still remaining above the Federal Reserve's 2% target rate, officials have signaled another rate hike by a quarter point at its next meeting in 2 weeks.
The sense of the summary of economic projections and the decision really is just that, given how far we've come, it may make sense to move rates higher, but to do so at a more moderate pace.
If the Fed raises the rate by 25 basis points this month, it'll widen the gap in rates between South Korea and the U.S. to a record high 2 percentage points. One expert says the widening gap between those rates could lead to capital outflow from South Korea, but he believes it's not likely to cause volatility in the foreign exchange market.
There is a chance that it might cause instabilities in the currency market and accelerated capital outflow, but right now that possibility seems very low. Even though the interest rate gap is 1.75 percentage points, the currency market has been relatively stable.
The same expert adds, as long as it is slow and steady, the Korean economy can handle it, and that the country is currently in a position where the risks of raising the rates outweigh the risks of maintaining them. Eum Ji-young, Arirang News.